Grayscale stakes 102,400 ETH worth 237 million from its trust. Grayscale has staked 102,400 ETH from its trust holdings, worth roughly $237 million at current prices, according to a Cointelegraph post on April 25, 2026. ETH is trading at 2318 as of the same date, up 0.6% on the day and down 3.7% on the week per CoinMarketCap data, which puts the staked tranche just under $250 million. The headline number matters less than the precedent. Until recently, U.S. asset managers holding ETH for spot ETF and trust products were either prohibited from staking it or chose not to, leaving billions in productive capital idle on the network. Grayscale activating staking on a six-figure ETH balance is the clearest sign yet that the wall between traditional ETF wrappers and on-chain yield is coming down. $250 million in productive ETH 102,400 ETH is not the largest staking pool on the network. Lido alone manages more than 9 million ETH, and Coinbase's institutional staking arm sits in the millions. What makes this stake different is the source. An asset manager moving its own trust holdings into validator yield rather than custodying them passively. At the current ETH staking yield of roughly 3% annualized, 102,400 ETH generates about 3,072 ETH per year, or close to $7.1 million at the April 25 price. That is real recurring revenue against a holding that previously sat dormant. For a fund manager that charges management fees on the underlying NAV, staking yield can offset expenses or flow back to shareholders depending on how the wrapper is structured. The composition of the validator set Grayscale chose has not been disclosed in the original post. Whether they ran their own nodes, used a regulated staking as a service partner, or routed through Coinbase as their existing custodian will determine how much of that yield Grayscale keeps versus pays to operators. Why this matters for spot ETH ETFs. The first wave of U.S. spot ETH ETFs that launched in 2024 launched without staking. Issuers, including Grayscale, Fidelity, and BlackRock, all listed wrappers that held ETH as a passive asset. Investors were buying ETH price exposure at the cost of management fees, with no yield to offset the drag. That structure put U.S. ETH ETFs at a disadvantage to European products like 21 Shares and the Nordic ETPs, several of which already passed through staking yield. It also left a clear competitive vector. Whichever U.S. issuer activated staking first would have a fee structure that materially outperformed peers. Grayscale staking from its trust is a step toward that activation, although it is not yet the same as a spot ETF passing through staking rewards to retail holders. The trust structure has more flexibility than the ETF wrapper, and the SEC has been reviewing staking ETF filings throughout 2026 without committing to a clear timeline. A move from trust to ETF is the next domino. What 3% yield looks like across asset manager ETH. If the rest of the US ETH ETF and trust complex follows Grayscale's lead, the math gets large quickly. Combined US spot ETH ETF holdings sit near 4 million ETH at current prices, worth roughly $9.3 billion. Staking that pool at 3% would generate about 120,000 ETH per year in yield, or $278 million annually at today's price. That yield, if passed through to ETF shareholders, would offset most U.S. ETH ETF management fees and turn the products from cost-incurring exposure vehicles into mildly yield-producing ones. It would also lock up a meaningful chunk of liquid ETH, since staked ETH cannot be sold until it is exited from the validator queue, which currently runs days to weeks depending on network demand. For ETH price dynamics, asset manager staking is structurally similar to corporate treasury accumulation in that both reduce circulating supply available to spot markets. The difference is asset manager ETH is theoretically redeemable by ETF holders at any time, while corporate treasury ETH is locked by management decision. Risk sitting behind the number staking is not free of operational risk. Validator slashing penalties, although rare, can result in loss of principal if a node operator misbehaves or experiences sustained downtime. Smart contract risk applies if the staking is routed through a liquid staking protocol rather than direct validator deployment. Although nothing in the original Cointelegraph post suggests Grayscale used a liquid staking wrapper. There is also exit queue risk. ETH exiting the validator set goes through a withdrawal queue that has historically taken anywhere from minutes to weeks, depending on how many validators are exiting at the same time. If an ETF needed to redeem rapidly during a market panic and a large portion of its underlying ETH was staked, the redemption process could be slowed. These are manageable risks at institutional scale, but they are reasons asset managers moved cautiously on staking in the first place. Grayscale taking the step on 102,400 ETH suggests their internal risk committee is satisfied with the operational setup.